Hi, I'm Doug Carroll for Insider's Guide to Finance.com with the second in a series of videos on the very important topic of implied volatility. The focus of this video will be on what are the factors that determine, at least in an option pricing model valuation sense, the value of volatility as measured via Black-Scholes. For those not familiar with the determination of implied volatility, you need to take a look at that first video in the series, but to briefly recap, implied volatility is a plug. You take the value of the other four variables for which you can get good values: market price of the underlying, strike price of the option, interest rates, and time to expiration, as well as taking the market price of the option as a given and in effect run Black-Scholes backwards. Solve for the value of volatility consistent with the observed price of the option, or in other words, the value of volatility implied by the market price of the option. In other words, volatility in an option pricing sense is completely different than volatility, or more formally, the way it's expressed in mathematics, standard deviation, or its square, the variance. It's completely different. In a mathematical sense, variance or standard deviation, the common measures of volatility, are computed by taking the difference between the observed values of the variable of interest and the average value of that variable over some time frame. Obviously, volatility in an option pricing sense is completely different computationally. So what are the factors that drive volatility in an option pricing sense? Note, given the way volatility is measured, volatility is it's a catch-all. It's a fudge factor. In other words, any change in the value of the option that you can't explain away by changes in one of the other four variables by default becomes a result of, oh, it's a change in implied volatility. Now, saying implied volatility is a fudge factor is not to in some way malign it, it's just to try to express it accurately in a relatively casual sense anyway. Is everything that could possibly affect the price of an option reflected in the Black-Scholes formula? Obviously not, it's a model. Models don't attempt to recreate reality. Reality is way too complicated and too messy. Models attempt to boil reality down to its bare essentials. What are the primary drivers of the variable of interest? And by understanding how changes in those primary drivers are related to changes in the variable of interest, in this case the price of the option, we can better understand the factors that will drive value. What are factors that could possibly affect the price of an option that aren't reflected in the model? Well, there's a real-world factor that affects asset prices across all markets. Everyday markets are open that's not captured in the model. And that's one of the primary drivers, in fact, the primary driver of this thing we call implied volatility. Now, just to set that explanation up, let me give you a throwaway example. In other words, what's a real-world factor that could affect option prices that's not captured in the model? Well, for instance, what about tax rates on option profits? For instance, let's say the government took the position that the only people that trade options are speculators, and speculation is a really bad thing, so we need to discourage excessive speculation. To do that, we're going to tax option profits at 99%. Well, what would happen to option prices if option trading profits were taxed at a 99% rate? Well, chances are the value of options would go down because there would be much less demand for them. Now, why isn't there a factor for option tax rates in the Black-Scholes formula? Well, the taxation of options changes once every 2 or 3 generations. A factor that changes that infrequently doesn't need to be measured in a model that we'd use on an almost continuous basis. Now, I use the example of the tax rates on options just to illustrate the point. Let's now focus on the nub of the issue. As I indicated before, there's a factor that impacts the value of assets in all markets on an everyday basis, at least potentially, that's not captured in the model. What would that be? Well, how about the supply and demand for options themselves? Clearly, the balance between buyers and sellers is going to have an impact on asset prices in any market, and yet the balance between buyers and sellers, supply and demand for options, is not reflected in that model whatsoever. Consequently, anytime there's a change in that balance between buyers and sellers, that imbalance between buy-side and sell-side pressure is going to have an impact on option values. And since that wouldn't be captured in any of the first four variables, by default, any change in the balance between ready buyers and sellers is going to have to manifest itself as a change in implied volatility. Now, let me not leave the explanation so abstract. Let me put it in context. What are some examples of real-world events in the sense of forecastable times when we know potentially market-moving information is going to come out, which would have a visible impact on option values? Well, of course, there are many examples, but probably one of the most obvious is something that happens 4 times a year that will affect many equity prices, and that's, of course, earnings announcements. Now, if one were to look at the implied volatility as calculated, as discussed previously, and you look at option series expiring before the earnings announcement versus the options series expiring after the earnings announcement date, there's a dramatic difference in the implied volatilities. Those option series expiring before the earnings date will have lower implied volatilities. Those that expire afterwards have much higher implied volatilities. Why? Well, of course, there's much bigger demand for the options expiring after the potentially market-moving news comes out. You've got people wanting to buy those options either to profit by the expected move or maybe defend existing positions from the feared move in the stocks. And that bigger demand for options that will expire beyond the date of the earnings announcement is reflected in the form of higher implied volatility. Now, it's not just earnings announcements that would have that impact. Any predictable event, for instance, biotech stocks are oftentimes heavily impacted by the news that comes out at the industry conferences of biotech companies, where companies will announce the results of FDA trials and stocks will quadruple or fall by 90% when the news comes out either better or much worse than anticipated. Or occasionally there are court cases where the market can anticipate when the finding of the courts will be released. And again, options expiring beyond that date will trade at much higher implied volatilities. So, as indicated before in the first video in the series, I'm not going to say that there's no aspect of dispersion of expected outcomes and implied volatility. And clearly, market-moving news or potentially market-moving news will cause there to be a greater uncertainty about the range of possible movements in the price of the underlying stock and consequently big moves in returns. But at least in an option pricing model valuation sense, implied volatility is primarily capturing that supply and demand for options or balance between buyers and sellers. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, there are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.